Well, good evening, ladies and gentlemen. Welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight I'm going to talk about managed funds. So last week I did a video on LICs, or LICs, or listed investment companies, as some people like to call them. And this is a bit of an extension of that, because a managed fund is another investment vehicle that you can use to invest in shares. So just before we get going, I'd like to do a big thank you, because our channel has just hit the 50 subscriber mark. So that's a really big achievement. I'm really happy with how things are going. Thanks so much for everyone who's watching. And if you haven't already, make sure you hit that subscribe button, because I really love doing these videos and it's just awesome to have that support. But let's get back to managed funds. So a managed fund is actually really one of the first types of investments apart from shares that came out. They're quite an old-fashioned idea. So both LICs and ETFs, which are the other major forms of investing apart from shares, have actually only been around for a couple of decades at most, but managed funds actually have a far longer history. So Americans often call managed funds mutual funds. If you hear the term mutual fund, it actually just means managed fund in Australia. So a managed fund is actually a trust. It's not a company and it's not listed on the stock exchange. So unlike an LIC or an ETF, you can't buy shares in a managed fund on the stock exchange. What you can do is buy units in the trust. Now, a unit is really just another word for a share, but officially trusts don't have shares, they have units. So when we talk about managed funds, it'll be in units. So because a managed fund is not traded, so it's not on the stock exchange, you actually have to apply for it externally. So normally when you apply for a managed fund, you have to fill in a bunch of forms and send a check off to the company who runs the managed fund. And then the managed fund will buy the units of the trust on your behalf. So in this way, you don't pay brokerage, you don't buy shares, and that means that you actually can't buy and sell the units as easily as you would shares on the stock exchange. Now, this has a few advantages and a few disadvantages. As I mentioned earlier, one of the advantages is that when you buy and sell managed funds, you normally don't pay brokerage. The company who runs the fund might charge you a buy and sell spread, so that's a small fee for buying and selling the units, but it normally won't be anywhere near as expensive as brokerage is. And once you buy into the managed fund, you'll normally won't have to pay any more for buying additional units. And after you initially buy into the managed fund, you can normally enter into what's called a regular investment program. And so you can make regular contributions to the fund, and the fund won't charge you for these contributions. So that's one advantage it might have over an LIC or an ETF. Also, managed funds are taxed differently to shares or ETFs or LICs. So that's also something to keep in mind. So when you buy into a managed fund, you're actually pooling your money with a lot of other people who have already bought in the fund. Now, the fund will have what's called a fund manager, and it's the fund manager's job to invest your money on your behalf. So in this way, a managed fund is another form of active investing. So it's quite similar to an LIC in that regard, as you'll have a fund manager who's actively buying and selling shares on your behalf. So unlike an ETF or an index fund, your investment isn't just following, say, the top 200 companies in Australia. The fund manager is actually picking companies that they think will do well over the long term. Now, most managed funds will also have what's called a minimum investment. So unlike shares where you can invest as little as $500 at a time, a managed fund will often have a threshold for investing. So it's often $5,000 or $10,000 or $25,000. And some managed funds even have $100,000 or $500,000 thresholds. So there's a real difference in how managed funds are marketed. Some are marketed for really wealthy people and some are marketed for beginners. So that's the number one thing you should probably look out for in a managed fund, is if you actually can invest in it, if it's for you. So why would anyone consider investing in a managed fund? Well, the whole point of a managed fund is basically to outperform whatever index they're looking at, because in a managed fund, you have to pay the fund manager fees because it's their job to look for stocks that they think will outperform the market. So whenever you invest in a managed fund, part of your money is paying the fund manager, and that's very similar to an LIC. So the first thing you should be looking at when you invest in a managed fund is, has it have a history of outperforming the index? Because remember, you're paying fees for this fund, and an index tracking ETF will normally have extremely low fees. So for example, an ETF might have fees of 0.2% of your money every year, whereas a managed fund might have 1%. So that's 5 times higher. So you really have to look at, are you getting value for money when you invest in a managed fund? If a managed fund has a history of underperforming the index, you're basically paying someone to lose against the market, and that's really a terrible use of money because you may as well just buy the ETF and get a better return. Now, another thing to keep in mind is most managed funds don't do this. Something like 80% of managed funds on average underperform the market. So really, if you're looking at a managed fund, you should be looking at the 1-year history, the 3-year history, the 5-year history, and maybe even the 10-year history, and seeing how regularly it outperforms the market. Because if it doesn't outperform the market or just matches it, you're really far better off just going with an ETF. So there are actually very few managed funds that manage to do this consistently. So if you're looking at a managed fund, it's really a case of looking for the diamond in the rough. Because 8 out of 10 managed funds won't have a history of outperformance, but it's really finding those ones that do, that maybe return over 10% a year, say 12, 15, 17%. Some of them can. But it takes a lot of research to find these. So what are the advantages of a managed fund? Well, if you find a managed fund that manages a history of outperforming the index, you can actually get what a good investor might get without having to do any work. So most investors who buy and sell shares themselves judge their performance on whether they beat that market return of about 8 to 10%. So if a managed fund is consistently beating that return, then you know that it's actually a pretty good investment despite the fees you have to pay. Because if a managed fund is outperforming the index by 3 or 4% and you're paying a 1% management fee, you're still beating the market by 2 to 3%. And that's a really, really good outcome because you'll manage to grow your wealth quite quickly. So if you're looking at managed funds, that's 2 really important things to keep in mind. 1, does it outperform the index on a regular basis and over the long term? And 2, what kind of fees are they charging? Because if you're paying someone to underperform the index, you're really losing money on every corner. So it's really easy to actually just do a bit of research on managed funds. All you have to do is type into Google Managed Funds Australia, and you'll get all sorts of pages that compare managed funds, and you can sift through them and see what kind of managed fund might work for you. So a couple of famous fund managers in Australia include Magellan, Platinum Asset Management, Fidelity Asset Management. Any one of those has a couple of really good quality managed funds that you might want to look at. And a lot of these companies run different funds depending on your perspective. So some run funds that are focused on income, so paying you dividends. Some run funds focused on investing in Asia or other emerging markets. Some funds just concentrate on the Australian market. Some funds do the US market. There's a whole range of different managed funds. So if you're looking at managed funds, try and find one that fits your style. And I'm sure that with enough research, you can find a good managed fund that outperforms the market that you might consider investing in. Okay guys, thanks so much for watching. If you found this video useful, make sure you leave a like on it. And if you haven't already, of course, make sure you hit that subscribe button. Thanks so much for watching. I'll have more videos out soon, but for now, good night.